Hey, hello, this is Martin from Secret channel for learning about trading and investing, and welcome to a brand new episode of Option Trading Strategy series. And today we're going to touch base on a very good monthly income generating strategy, which is a double ratio spread. So, what exactly is a double ratio spread is neatly shown in this slide. We talked about call spreads earlier. We talked about bull spreads also earlier. If you've not seen that videos, you can look at the description and you'll have a link to that, and the playlist also you can find that. Right? No, there are videos already available for you. So basically, call spread is nothing but it's a bullish side and a bearish side. Moderate bullishness is what we look at. Right? So it is a so a bull call spread and a bear put spread. Right? That is from where the call ratio spread and put ratio spreads are derived. Call ratio spread is actually just doubling that call side and the pull side. Wherever you're selling, you will have twice the quantity of what you're buying. Then it becomes call ratio spread. If the right, so where the reverse backside is completely protected with a small profit, and similarly on the put ratio spread, the call side is protected, and combination of this call ratio and put ratio is what we have, double ratio spread, right? That's how it looks like. It's also known as Batman strategy. It is not fully hedged, right? But we have a very wide range, and we can add the hedge on the weekly anytime we want. Normally it will work on volatile moves, which often happens in Bank Nifty than Nifty, but Nifty option also it may work on, and gives a very wide range. So very rarely would that range be broken once in 6 months or 1 year or something like that. If it all breaches, we can always hedge it. Or if you don't want to take the risk also, you can hedge it, but the profits will be slightly reduced. But we get a beautiful wide range. So how do you buy that, right? So this is one way of taking the strategy. Basically, this example here is based on the strategy rules. It's based on Bank Nifty monthly options. You will have to try out the different combination of Nifty, other stocks, weekly, and all that. You can try it out on your own. You can backtest and that. But this is just to introduce you to that, right? So less than 20 delta buying of the call, right? Let us search for it. And then find that call option which is having less than delta on the Bank Nifty for the previous month's expiry date. That is where it starts from, and the position has been taken for the next month. Right? So, for example, if you're taking it for June, May end monthly expiry is where we are taking it. That is after 3 o'clock, 3:15. Right? Look for 20 delta, buy one lot. Look for 15 delta below, whatever is coming below. Buy double the call option. To repeat the same on the put option side also. Look for less than 20 delta, for less than 15 delta, double it and do it both sides. We have what you call a double ratio spread. Right? The charges should not be more than 2 or 3% is what you are doing. Right? And it's very difficult to breach that range. It is a very wide range that we will be seeing that in the simulator later in the last slide. Now adjustments are different ways of adjusting. You can happily do the hedging on the side by breaching, and then take the loss if it further moves beyond your imagination, right? And similarly, you can do that, and then at the same time you can increase your reduce your loss further. First you reduced and made it a small loss. You can further reduce it, or it may be possible for you to come out profitable also if you are selling double on the opposite side of where it is tested. It's untested sides. So if it is moving towards the call side, market is moving up, then take the put ATM and then sell it those 2 times. And we are explaining all this how it is done in the simulations. Remember that this is the movement that has happened. Right? Look at the big, nearly 70% of downfall, then going up again down and then moving up. Big moves is what we have captured in the 3 months: April, May, June, July. 4 months of simulation is there. And remember the VIX, no, look at the way in this 4 months the VIX how it has moved, right? Very volatile up to 13 when then dipped and again moved up and then again dipped back to the 19 levels. No, that's in August, but back to 20 below levels nearby. It's such a volatile move, and still we will see that it works like one more. Right. So let's go and see the simulation and how it works, and then I hope that'll give you more idea. So here you see stock mark. It's a backtesting application, and we're trying to see how we can backtest from for the 4 months starting from April, May, June, and July. So we would be testing it on the bank nifty, like you see here, and we will be simulating that on the pay charts. We'll be taking positions also here, and then we'll simulate what exactly that. So this is for the April month. For testing that, we will have to look at the previous month, March 31st, last expiry, and we are taking it after 3 o'clock. How do we trick it? Before that, the expiry has to be defined. The expiry has to be the April month's expiry, that is 20th April, and it is starting from the last day of the previous month's monthly expiry. Here we go, we are looking for less than 20 delta. So here you have 90, you buy one lot for the purpose, right? And then we look for less than 50. Here we go, we sell it, and we sell it double. Then again, we go to the other side, which is the call, and we look for delta less than 20. And here it goes. You buy it, one lot. Look further down for less than 15, and you sell it and double it. Now here, what you see the PEF is what exactly is a double ratio spread. Look at the range. Look at the range of break-evens that you're getting, right? There's no trouble as long as it doesn't reach 36, 850 and 39, 720, right? And we're going to start taking the trade from the previous days. At 3 p.m. we'll take the trade and we'll run the entire month and see what happens. So anything happens between this range, no problem. A peak profits will be at this top point, 33, 620, 39. So if it goes either side, so it helps to deal with the volatile markets, and let's auto run it on a daily basis and see what happens. Yes, the trades are taken, things are moving. So it's 1st April, 4th April, 5th April, going on. And market swings, it doesn't matter, right? It's well within the range. We can see the profits here, not much profit, some profit, and not much profit. So it keeps moving ahead. And we are coming to the end of the month, April 20th. We're not doing anything, not just such a wide range that we're getting. What do we do anything at all? It's April 25th, almost the end of the month. Right. And if you are getting 2% to 3%, then exit. Right? No, so right. So we have a profit of 5,475 without doing anything. Just put it on, wait for the month, and then right. Just for 2 lot selling and 1 hardly the estimated margin is 1.39 lakhs. Right? And we can also take hedge positions on the weekly. Every weekend we can buy that. We will even further reduce the margin amount that is required. So let's get to the next month, which is starting from this day where it expected, and then that's for the May month. And we'll delete all the positions that we have taken for the previous month. We clear it off. 26 bank nifty, starting from April 28th. After 3 p.m. we'll take the positions. And once again we'll be going and looking for less than 20, which is there here, and we'll buy that one lot. We'll look for less than 15, which is here. We'll sell it and then double it. So we have the put side of it. That's a put ratio spread, and we would go to the other side and look for less than 20, and we'll buy it. Further down, we'll look for less than 15, we'll sell it, and then double it. Here we have the Batman, right? What they call Batman sometimes. It's a double ratio spread, right? Put call ratio and put ratio both combined together. And we want to simulate it for the entire month, and started April 28th, and it moves on to April 29th, and then the entire May month. So we tested it for April month, we are testing it for May month, and the market moves 35 to 60 is where it is, and profit keeps getting added, losses getting added here, and we don't have to worry about it for an entire month. It's almost half a month now, May 12th. And we just freeze the pre-profit, and then we slip it, and then we have climbed back a bit. We did not actually breach it fully, you can say, and we are back in the safe zones. It was a big movement that happened again. We're going there, and once again we are back, and we did not decisively we did not breach that, and we are coming to the end of the month, May 25th, and it's almost done, and we have again another 5,000 profit. It's a regular income strategy, right? Now we're going there and deleting all those things and moving on to the third month, which is April is done, May is done, and we'll do it for June and 28th June, right? So we'll do it for May 26th, starting from May 26th for the June. That's what it is. And after 15, Bank Nifty will once again start looking for less than 20 delta. Here we buy it one lot. For the down, we'll look for less than 15 delta, and we'll sell it and then double it. Similarly, we go to the call side, look for less than 20, buy it one lot. For the down, we look for less than 15 and sell it and simply double it. Look at the payoff. Here we have the Batman. Here we have the double ratio spread. Further break-evens, max profit, PNL, all the payoff details are given here. Once again, we are simulating the run. It starts up. Today is 7 May, and we are getting the June, and our June month price moves here and there. We sit back and wait and wait and wait till the break-even of the payoff graph is reached, which is coming to 38,500, that range on that side, and this side 31,400 kind of range. So nothing happens, price keeps moving, simulation happens, right? And nothing much happens, and we are in the almost the half of the month is over. June month is over. Violent swings are happening, but the advantage is that the range that we are getting, right? We are going down, we are going once again up, we are going down, and we are into the last 10 days, last week, almost there, and still we are not outside of the range that we have got. Till 31,400 we are safe, right? That's a big range that we have got, right? 5,000, 6,000, 8,000 plus 6,000 kind of range is what we're getting. So that is advantage. We can be stunned, and we are again having 5,460, right? Remember, we are going through a violent move from April to June, July, right? It's a V shape with multiple ups in between. That is what we are dealing with. Remember that, right? So once I think a profitable month, we go back and delete and clear off that, and now comes the trouble month, which is we want to take it for July, right? So April is done, May is done, June is done, we're going to July. Once again, we will go and look for an entry which is less than 20, buy it one lot less than 40, 15 delta, sell it, double it. Call side similarly, look for less than 20, buy it, less than 15 delta, sell it, and double it. Here we have the payoff. This is a double ratio spread, and we want to simulate it for the July month. Let's see what happens. That was a very violent month. Remember, around 11% plus kind of move happened in the July month. So it is likely that it can breach this what we have. There's a possibility that we can breach that. So we'll pause it and then exactly see where the breach is happening and take the adjustments also. Right. So now it's not reached, it's almost half the month is over. The actual big moves came in the last week towards actually one expiry day of 28th July is where the action happened. Big breach is going to happen. I'm going to pause it and then we'll adjust and exactly we'll take the positions. Right? So it's breached. So you'll have to go back. A little bit, you have to go back. We're going back. Currently, we're going back. Yeah. So 36. We're going back. And the breach would have happened here at 36,500 levels. 36,500. One aggressive way of adjusting is normal breaches 36,500. We will go and sell the put option and double it. Right. That is 36,500 put option. We double it. Payoff will be crazy kind of payoff, but we expanded the range and we have some breathing space now. We would continue to move that, but this time we'll move it slowly. 30 minutes each. Right? Or we'll first move it and then see what happens. Right, so if it is more than 37, then once again we are breaching. Remember we started, yes. So if we had not done anything, we would have got lost 5,000. But let's assume that we would have adjusted it before it actually breached. Right, we can do that. So the breach happened very close to 37,000. Right, that's a break-even point here. So let's say 37,100. We can once again sell the put, not the call, because call is where the tested side, the non-tested side, we have to sell it once again, go here and double it, right? And payoff will give us more range, right? Now it may not, right? See here, in spite of 11% of move, what we have lost is just 960 after making more than 16, 17,000 in the last 3 months. So 3 months, right, with such violent moves happened. We just waited for 3 months and we made more than 15, 16,000. No, more than 15,000 for sure. And just 1 month where we had a very violent move in July month is where we lost. That's all. So that's the power of double ratio splits. It works in volatile markets, right? And gives a very good range. Hope it helps.